Hello everyone. Welcome back to another lesson. This should be the second to last video in the series. So that's pretty exciting. We're almost there. We're almost at the finish line. Today, we're going to be talking about another very important topic, one that I find a lot more interesting than the last one. So hopefully that excites you, because I know fundamental analysis, as I said before, is often a drag. So hopefully this is probably my favorite lesson. So hopefully you find it that way as well. Hopefully you end up enjoying this too. So, well, first of all, I think the question is, what are we going to be learning today? We're going to be talking about another kind of analysis. It's called technical analysis. Last time we had fundamental, now we have technical. So, the first question obviously is, what is it? What we do in technical analysis is we try to find patterns and trends in stock prices to figure out the best time to buy or sell a stock. So what do we mean by this? Well, in essence, what we're doing by finding these patterns is, well, our end goal is to be able to make an educated guess on when the price is going to go up or down. Now, that sounds like magic, right? Like, how on earth can we, like, the stock market seems like such, especially in the short term, it seems like such like a random thing. Obviously, like, hopefully I convinced you, like, in previous videos, that over the long term, we can, using fundamental analysis, we can predict if the stock's going to go up or down over the long term. But over the short term, it seems like voodoo. So how are we going to be able to do that? And so, well, before I get into that, let's cover a bit of background first, because last time we talked about fundamental analysis, so let's do a comparison. I'll just say tech versus fund. Fund means fundamental analysis. Let's do a comparison before we dive into the actual patterns. So the difference between technical and fundamental analysis ultimately comes down to the difference between trading and investing. If you remember, in the first video, second video, it's either the first or second, I don't remember, but I talked about trading versus investing, and I made a big point to emphasize what that was. So in case you need a refresher, trading is short term, buying stocks over the short term, selling them like very soon, maybe like days, weeks, sometimes even hours after you buy it. Investing is investing for the long term, which is what I've been emphasizing. That's what I've been emphasizing the entire series, is how can we invest long term, because long term investing brings the most gains and it's the easiest to do. So that's a brief refresher on what that was. So how these concepts tie into technical and fundamental. Technical helps with trading, and fundamental analysis helps with investing. And so, like I said before, technical analysis is usually used for short-term investing. Short-term trading. I have to be careful with my words. Short-term trading. And so, ultimately, what this means, what any kind of like trading in the short term means, is that we don't care. We don't care about whether a stock or whether a company. We don't care about whether a company is. Oh, hold on. I'll finish writing this down first. so I don't get ahead of myself. We don't care about whether a company is strong or not. Is a strong company to invest in. In short-term trading, we don't care about whether a company, like all that stuff we covered in fundamental analysis, like analyzing the strength of a company, using the financial statements, using the qualitative characteristics. None of that matters in technical analysis. The only thing that matters is whether the price will go up in the short term. The strength of a company, it will let me put it this way: if it doesn't matter if the company is strong or not. Like any stock is going to go up on some days and down on other days. Even if a company is like super weak and is about to like go bankrupt, there are still some days where it could see an increase in price. And the goal of technical analysis is to locate these areas where the price can go up. And so they don't care about whether it's like fundamentally a strong company or not. They just care to identify the trends and the patterns and predict when it's going to go up. So that's a key difference. And obviously, it seems like it's going to be a lot harder than fundamental analysis, and in some ways, it is. So we'll get into that later. So the big picture here is that primarily we want to primarily use fundamental analysis. Because, like I said, you know, I've been emphasizing this entire video series that long-term investing is the way to go. Investing will bring far more returns over the long term than in the short term, and it's far safer as well. And so we want to be using this fundamental analysis that we learned in the last video to make our decisions. So your question might be then, why am I even devoting a video to covering technical analysis? Like, why does it matter if it's only used for short-term trading? Why do I care to use it if we're looking to the long term? And so I will cover like at the very end of the video the how we can pair technical analysis and fundamental analysis to create a strong to make an even stronger stock purchase. But that's far later. Right now, before we get to that very end of the video, we're gonna now dive into what exactly technical analysis actually is, the parts of it, and the very fundamental part of not in the fundamental analysis sense, but the very basics of technical analysis. The very baseline of it is candlesticks. Candlesticks are not the type that you like burn for like made of wax and that you burn for heat, but candlesticks in the sense of technical trade analysis are the bread and butter, the very basic entity of technical analysis. And so we're basically just going to be spending this entire video talking about candlesticks. And so what they're used for is they're used to identify patterns. Oops, I can't spell. Identify patterns. This is the candlestick patterns is how we're going to be finding our patterns and finding when the stock's going to go up and down. And there are two types. Bullish and bearish, of course. If you remember from, I think, the second video, Intro to Stocks, bullish means that the stock is going to go up. Bearish means it's going to go down, right? How a bull attacks is swinging his horns up. A bear attacks by swinging his paws down. And so, what each of these types are? We have the bullish. What you could probably guess. The bullish candlestick shows that price went up, and the bearish means price went down. I think I got ahead of myself here. I think I should first clarify like what exactly a candlestick is. So I will draw some candlesticks here, and I will show you what they are. So candlesticks are usually we have bullish and bearish. So you might be able to guess the bullish candlesticks are usually green, and the bearish candlesticks are red. So a candlestick usually looks like a bullish candlestick will look like this. Here's our bullish candlesticks, and our bearish candlestick is red. Also, another common color coding is a black candlestick. A white candlestick will often be bullish, and a black candlestick will often be bearish. But the green and red look better, so I'm using it here, and I think it's more common. So what a candlestick does, I'll write this down. A candlestick shows price movement. My spelling is really off today. Price movement in a certain period, in a certain time period. That is what I meant when I said that for a bullish candlestick, the price went up, and the bearish candlestick, the price went down. What I meant to say before that, but I sort of skipped it. A bullish candlestick means that the price went up during the specific time period, and a bearish candlestick means that the price went down in a specific time period. Usually the time period, per day. Usually you see candlesticks daily, so a bullish candlestick will mean that the price went up throughout the candlestick ended the day at a higher price than it did when it started. And bearish is just the opposite. The price at the very end of the day is lower than it was when it first started. But you can have any time period. Very short-term traders will often like to use hours. We call them day traders. A day trader means that they don't hold a stock for longer than a day, so they sell it within the trading day, which is very hard to do and not very smart in my opinion. But they would use an hourly. They can use an hourly time period. You can have a daily period, a monthly period, a yearly period. Really, you can have any. You can customize the time period, but the daily period is, I think, the most common one and what you'll see the most and probably use the most. So, there's that. So now, what does this candlestick mean? Like, what is all this here? What can it show you? So, let's start with these two ends here, the top and the bottom. These are called the wicks. I'll just draw the arrow here, but the wick is the top and the bottom. So the wick shows you the extreme prices. What I mean by that is that the top wick, that's this one right here, it shows highest price in the period. So we're talking daily. This is the top wick will show you the highest price in the day, and then the bottom wick, you might be able to guess, shows the lowest price in the period. So this right here and this right here shows you the lowest price in the day, if we're talking about a day as a period. And so that's that out of the way. The other part, that would be this section right here. Call that a body. And the body, the body shows price that the stock started at. We call that an open. That's the price that the stock opened at, right? Because well, hopefully that word makes sense there. Open and price that it ended at. You might be able to guess we call that a close. That's the price the stock closed at. And so the tricky part here is that, well, first of all, for wicks, it doesn't matter if it's bullish or bearish. The top wick will always show the highest price. The bottom wick will always show the lowest price. But for the body, the bullish and bearish are different, and that should make sense because here, this top line here, the top line of the body is the close price, and right here, the bottom line, the line right here, is the open, and that should make sense, right? Because the bullish candlestick shows you the price movement of this, the price movement of the stock. It shows you that the stock moves higher, the price increased. So in order for it to increase, it should close higher than it opened because it has to go up in value. So hopefully that makes sense. And you might be able to guess, but likewise here, this top part for the bearish candlestick should be an open. And the bottom line here should be a close because it has to have started the day or the period at this high point and ended at a lower point. So hopefully that makes sense. It's a bit tricky because it's not as simple as the wicks, where it's constant for both. You have to keep in mind that for bullish and bearish, it's different. So that is the basics of the candlestick, the very basic of the candlestick, what it is. So let's see what we can actually do with it. Actually, before I want to do that, I want to show you an example, just a sample candlestick graph. This, you might be able to guess. I got it from, of course, my good friend Yahoo Finance. Here you can see the ticker here, NKE, that's Nike. So this graph here is Nike. You can see all the candles here. We have green and red candles. So let's just pick any candle at random. Let's say this one. You can see it's a green candle, so it's a bullish candle. We can see it started the day right here at a low price. What is that? That's about $157 or $156, and throughout the day it moved up to about $161, $162, which is pretty good. That's a pretty good increase, pretty sizable increase. So that is how you can read the candlestick, one individual candlestick, and then the high and the lower we can see are pretty close. The wicks are pretty close to the body. So the high is probably pretty close to the close, and the low is probably pretty close to the open. That's not that important, but you can see what we can see here. Each of these individual candlesticks is 1 day. That's what I set it to. You can see the interval up here is 1 day. And you can see we have this entire period. The dates at the bottom got cut off, but this is a pretty long period. I guess at least a year. And so so we can see, actually no, it doesn't look like it was a year. About maybe, what is that? About 8 months? I'm not entirely sure. But we can see each individual day across a really long time period. And you can see trends. We can see that over here, the stock tended to trend lower because the price is getting lower and lower. And up here, we can see a big reversal where it's starting to trend upwards. So that's what we can see from a candlestick chart. And you can see, we can very clearly identify past patterns. But how can we predict the future? How can we see what's going to happen in the future? Well, that's what we're going to talk about soon. Let me just get situated. So now we're going to finally dive into patterns that we can see from a candlestick chart. One of the most important ones is support and resistance. Support and resistance are very common stock patterns that you will see on a candlestick chart. And what each of them are is support is a line that a stock price struggles to get below. In other words, the line here is supporting the stock price. It's not letting it fall below. I'll illustrate it here. If we have a line here, the stock price could, let's say the stock price is like this. It'll come here, meet the line, but bounce off, come back again. Let's say it tries to go past it again, bounce off, bounce off. We call each time it bounces off a test. It tests the support, and we can see each time the support keeps it from going below it. And then on the other hand, resistance, a line that a stock price struggles to get above. So it's blocking a price. The line is blocking the price from going higher. So you can have it's pretty similar to the opposite scenario, to the support scenario. You test it, fails to get below, fails to get above it. Test again, test again. It just fails. It just can't get above it. It just can't cross it. And so that's what a support is. And keep in mind, a support and resistance. Sorry, that's what a resistance is. A support and resistance don't have to be straight lines like this. They don't have to be horizontal lines like this. You can have a slanted support, where the stock price goes like this. Slanted resistance. And one of the coolest things that I think from support and resistance that I think is that I've noticed and is pretty common is what's known as the channel, where we have here, I'll label it. It's called a channel. We have a resistance up here and a support down here, and the stock price just bounces between them, which is pretty cool if you ask me. It's pretty crazy. I have an example I'll show you later, but I mean it's just it's crazy to me how these patterns can just form from just people from just individual people just buying and selling stocks. It's just unbelievable to me. And so well, you might be wondering, like, how did this happen? How in like a completely random market where like there's so many moving parts, how can like very like exact pattern like this happen? And so the reason is that for a support, investors will pick a price for a stock, and they think like if a stock goes below this, it's probably undervalued, and so I'll buy when it hits here. And when a lot of investors believe that, then as the stock goes down, they reach this critical point where they think, oh man, the stock is undervalued, I'll buy now. A lot of investors will buy here and drive the price back up, and that'll keep happening until some sentiment changes, and investors decide that, hey, this is probably a good buy now, and so the support will move or it'll go away, and I think I reversed that. This will continue until people think like, man, this company is not that good anymore. The price probably the price is probably going to go, the stock's not looking very good, and so the price is probably going to go down. So now it's not undervalued at this point anymore. So it's gonna go below the support, and I'll show examples of that. I know that was pretty long-winded, but I'll show examples of all that to help you understand it better. And so the reason why these matter, why support and resistance matter, is because they can help predict when to buy and sell. Think about it. If you have a support line right here, and the stock is hitting support, it's getting closer to support, and it reaches support, that's probably a good time to buy, because the stock price is probably going to go back up afterwards. And so if you buy at support, that's probably the lowest it's going to be for a while, and so that's generally a pretty safe place to buy. On the opposite end, for resistance, if a stock is getting closer to resistance, it's probably not going to be a good time to buy, because it's probably going to hit that, go back down, and then you have a cheaper price to buy it at. So that's how you can use support and resistance. It's pretty powerful, pretty cool. Now I will finally show you some examples. First one here, again, Yahoo Finance. This company is called, I'll take this away, hold on. This company is called NXP Semiconductors. You can see ticker NXPI. We actually have two examples of support here. You see we have this slanted support here. You see how the stock tests it right, tests the support here, 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 and here, and all 4 times it fails to pass this exact line. So this is a trend line that people think if it goes below it, it's probably going to be undervalued. It's a good place to buy, so they choose to buy it there. And then we have another support right over here. This is a horizontal support. And so I'll just do this to help you see it better. So you can see it tests here, here, and here, and it always fails to break that support line. So we can see two examples, two very, very clean examples too, of support just in one time period here, which is pretty cool. And hopefully this cements the fact that yes, support is a real thing, and it does occur pretty frequently in stock markets, and it's pretty powerful too. So there's that. Here is an example of resistance. This is Toyota, ticker TM. You see a horizontal resistance right here. It tests multiple, it is off screen. You can see it tests right here, tests here, tests here, and it tests multiple times right over here, 3 times in a very short time period. So this is a very, very strong resistance, and we can see that it's not easy to go above it. So the stock just keeps getting pummeled as it tries to pass this, what is that, probably 187, the 187 price value just keeps getting pushed down, pummeled and pummeled when it tries to go past it. So and it's because people, they think that the stock is overvalued when they reach this point, so they sell, and then it just drives the price down. So that's resistance. Here, this is Taiwan Semiconductor. Ticker TSM. Here we have a pretty awesome channel. You got your resistance there and your support here. Starts here. Test, 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 test. So you can see it just keeps bouncing between like I don't know, like a pinwheel ball between these two lines, and the price just can't get above or below these lines. It's just like stuck here. And so think about it. If you buy a stock here and sell it when it's here, and then buy again here, sell it when it's here, buy here, sell here, think about how much money you could make. That is what traders do. But I recommend not doing that, because we're not trading, we're investing, and you don't know when the pattern is going to break. You don't know if over here you sell it, you don't know if it's going to go back down again to support where you can buy it again. It could go, if it reaches support again and you buy it there, it could finally break support and crash below, and then you lose money because you're trading and not investing, and so you would lose money there because your plan has been foiled. And so clearly it can be powerful for traders, but I recommend not following that method and just using support and resistance like how I recommended you use it to buy stock when it reaches support and sell it up there. And I will get into like the proper way to use it at the end of the video, like I said before, but this is just like kind of like a teaser to that. So that's support and resistance. Next, I want to cover another very commonly used metric in trading. It's called a moving average. It's pretty simple, but it's also very important. You're taking the mean of prices in a certain period. So if you don't know the way you do that, you add up all prices and divide by the number of, I'm just gonna say days here. It depends on what each individual candlestick is, but like most commonly we use days, so I will use that. And so as an example here, let's take a 3-day moving average. Let's say the first day the price is 2, second day the price is 3, third day the price is 4. Well, the mean here, 2 plus 3 plus 4 divided by 3, right? 2 plus 3 plus 4 is 9. We're dividing it by 1, 2, 3 days, so we get which is 3. So the mean here is 3. I'll just preface this by saying, don't be afraid that I'm talking about math right now. We're not going to be actually calculating the moving averages. It's just to show you how we get it. We're not going to be doing much math here. And so what makes the moving average a moving average is that it constantly updates every day. So let's say the next day after this 2, 3, 4, let's say the next day happens to be 5. So right now we're taking a 3-day moving average. For this example, we're doing a 3-day moving average. So we're only averaging the most recent 3 days. So right now we have 2, 3, 4, 5. Because we're only doing a 3-day moving average, that means we kick this 2 out. We kick the 2 out, and we only take the average of these 3 numbers here. So 3 plus 4 plus 5 over 3. That's 12 over 3, or 4. So your new moving average is 4. So that is what the moving average is. That's what makes it special. And you might be able to see why it's so important in trading, because the stock price changes every day, and we're adding a new day on top of it. So it's pretty important in getting a general idea of what the price is. Some common moving averages, I'll abbreviate NA. Common moving averages are 50, 100, 200 days. So we got pretty long periods. And that's why we're the Yahoo Finance or any other trade like investing site will tell you what the moving average is. So you don't need to be adding up like 200 days to calculate the moving average. It'll tell you what it is. And a really interesting property of a moving average is that it can act as support or resistance, which is pretty cool. I'll show you an example of that. And a final really important thing is that if the price crosses above, it is often a bullish sign, meaning the price will increase even more. Vice versa for the other way around. So if it crosses below, it's often a bad sign that the price will decrease. Some examples. Here, this is the company NVIDIA. They are a chip making company. Ticker NVDA. The purple line here represents the moving. This is a 200-day moving average. You see how one thing I didn't mention that is pretty important is that notice how it's sloping upwards. The reason being because as the price is getting higher, we can see the price really explodes over here. We can see that as the price increases, then we're getting rid of the lower days, right? Because it's only over a certain period of time, 200 days. So the first day in that period is getting taken away, and as we can see here, it's very low. And we're taking away a low number and adding a high number, which obviously will increase the moving average. And so we can see that's why it slopes up. That's why it's sloping upwards, because the stock's increasing in value. So we can see test, test, test. This 200-day moving average is acting as support. The stock is struggling to fall below it, and so that's why that's a pretty interesting property of a moving average, that it can act as support or resistance. I don't have an example of resistance, unfortunately, but hopefully you get the point. This right here, CVS, ticker CVS, and this is an example. Another 200-day moving average here. It's an example of how when a price crosses the moving average going up, then it can be seen as a bullish indicator. See right here, we have the cross. And after it crosses, it explodes. So that's a sign to watch out for. Also interesting over here, actually, we do see some support over here. Some resistance over here. It's blocking it from going up. But this right here is a cross, and it's bullish, because we can see as soon as it crosses, it skyrockets, and it keeps going upwards, as you can see, which is a good sign. On the opposite end of a spectrum, the bearish. This is actually not a stock, but it is the Nasdaq. This is the Nasdaq index, the performance of the index as a whole. Like the big tech stocks. You remember I talked about that in the second video, I think. So this is our Nasdaq index, and I picked it because we can see right over here, our 200-day moving average is being crossed below. And right here we have 4 big red candles. You can see it right here. 1, 2, 3, 4 big red candles. We're seeing an enormous drop. That's 1,000 points here. We can see right here is 13. I don't know if you can see it, but that's 13,700. This is 14,700. So over the course of 4 days, we're dropping 1,000 points, which is pretty crazy. So that's a powerful indicator of a crossing below as a bearish indicator. So that's moving averages. I think they're pretty straightforward. Although even though they are math. Sorry, that was I got ahead of myself. So now we're going to actually dive into a bit more detail on other candlestick patterns. So we're going. Technically, all the stuff we talked about earlier, like moving averages, support and resistance, aren't really candlestick patterns. They're just like occurrences in there's occurrences in technical analysis. What I'm going to be talking about next is these other types of candlestick patterns that you will hear about. And what a candlestick pattern is in this context that I'm going to be talking about is certain patterns of candlesticks, which is like wow, Sherlock, of candlesticks that appear in a certain way, and we hope that it can predict price movement. Some patterns predict a price increase, and others predict a decrease. Now, I want to talk about something very, very important here. No candlestick pattern works 100% of the time. You know, these are going to help us predict the future, but it is impossible to predict the future for certain. And so They're not going to work all the time. They're just likely to happen. So be careful when using them. I'll talk about how to do that later. I want to start this. Also, I'm going to mention that today I'm going to be talking about two very, very common, important patterns to know. But there are lots and lots of patterns. Like it is extremely overwhelming. If you look online, if you Google like candlestick patterns, like it is extremely overwhelming. There are so many, and so don't be discouraged to find that there are that many. You don't need to learn them all. I have not learned them all, and I'm not going to learn them all because that's just too much. And it's not necessary to know them all. Just know some of the most important ones, and you will be totally okay. So just a brief disclaimer. First one I want to talk about: bullish and bearish engulfing. Two opposite ends of the same coin. So let's start with bearish. Bullish. So we'll start with bullish engulfing. So a bullish engulfing is where you have a red candlestick followed by a green, I'll abbreviate CS, whose body completely covers body of the red. In other words, it engulfed it, which is why it's called that. And what this tells us, this is a very strong indicator that price will increase. Obviously, it's not 100%, but it's pretty good. It's a pretty good indicator, and I will draw it here. So we have a small red candlestick. Well, small. It can be small, it can be big, but the red candlestick, and is followed immediately afterwards, the day after, by a green candlestick. As you can see here, its body completely covers the red one. The wicks don't really matter here. So we can have the red wick extend all the way past this. I'll just draw it in. We can have this wick like go below and above, but usually you will see the it doesn't really matter as long as the body is engulfed. But most commonly you will see as the wicks will be below it too. But that what we really care about is the bodies. And so this, if you see this, that's a pretty good sign that the stock will start to increase. On the opposite end, bearish engulfing. Green CS followed by a red CS candlestick whose body completely covers the body of the green CS. And of course you may be able to guess, strong indicator that price decreases. Right? We have the name bullish and bearish in the name, so for bullish engulfing, it's a bullish pattern that the price will go up. Bearish is a bearish pattern that the price will decrease. And so to illustrate it, we have a green candlestick followed immediately by a red one. You can see its body is completely engulfed. This is probably one of the most important patterns that you will see, and it's pretty common too. So I will show you some examples of it. Here we have a company that you may have heard of Google. You can see ticker here, Goog, and the bullish engulfing in question is kind of small. I couldn't really find a better example, but it's right over here. See, we have a very small red candle here, and then the body of the green candlestick immediately afterwards completely covers it. You can see the wick of the lower wick of the red candle does extend a bit below the body of the green one, but that doesn't matter. It still counts as a bullish engulfing because the body is completely covered. And you can see we get this massive uptrend here. The price starts at about, what is that, $2,500, and it goes all the way up to $2,900. So that is the and this is all by a small bullish engulfing here. So powerful pattern, and also interesting here. I didn't intend for this to happen, but you can see a bearish engulfing right here, and the price does decrease a bit, but not by much. So that's where a point where the bearish engulfing might fail. But anyways, the point here is to show the bullish one here, and the massive price increase afterwards. Next, we have Netflix. Ticker NFLX. The bearish engulfing that I want to show here happens right over here. This is a huge bearish engulfing. We can see we have a very, very tiny green candlestick right here, and then an enormous red candlestick that completely covers it. So, and then we can see it's a very, very powerful and quick downtrend that we see happen very quickly afterwards. The price just crumbles, and so that's the power of the bearish engulfing right there. The other pattern that I want to talk about, the other really common one, is the doji. The doji is a bit more complicated. What it is, candlestick, where the open and close are about the same. It looks pretty much like a cross. You can see here, the body's right here. Body's here. The wicks. And you see how the body is so small because the open and the close are about the same. So we just see it as a line. That is a doji. What it means. It represents indecision. Among traders. Right? This should make sense because investors aren't really sure, or traders aren't really sure whether the price will go up or down. And so the people that believe the price will go up are going to buy it. People that believe it's going to go down are going to sell it. And ultimately, there's kind of like a canceling effect where because they aren't sure if it's going to go up or down, they aren't sure if it's a good buy or not, then the opening and close price are going to be about the same because they're not really sure which way to go. And so the importance of the doji, first of all, let's point out where it's not useful. When there's no obvious trends, it's not useful. However, the doji's importance comes from when there is a trend. The doji usually can be a sign of a reversal. Reversal in a trend. What I mean by that is that if the trend is going up, the doji can signify that the price will start going down, and when the price is going down, the doji can signify that it will go up. And so the reason why, let's cover why, is that if the price is in an uptrend, if an uptrend where the price has been increasing, then the doji means, right, it means indecision. So it means that the buyers the people driving the stock up, the bulls are losing strength. They're becoming less. They're becoming. There's a lot of indecision among them. They're not sure if the price will keep going up, and so, therefore a doji will appear, and then, and that suggests that they're losing steam, and we could be seeing a downtrend soon. And the reverse is true for the downtrend. So like I said, it's a little bit complicated. Unlike the bearish and bullish engulfing, the doji doesn't really give you a straight answer. You have to consider context around it. You have to consider the trends around it, but it can also be a very powerful tool to find out when a reversal will happen. So to show some examples, here we have Under Armour, clothing brand. Ticker UA. Right over here, we have a doji. This doji is green. I did not draw the arrow very well. It looks like it's pointing to the red one. It's supposed to be pointing to that green, the small green one right there. It's green because it closed a little bit higher than the open, but they're very, very close together. And so we can see we have this enormous uptrend here. Like there's so many like greens in a row. Doesn't seem like it's gonna stop. But this doji appears, which means that the buyers are losing conviction, they're losing steam. And then the sellers are able to kick in, the bears are able to kick in, and then immediately after they drive the price down. The price just plummets. And we can see that the buyers try to fight back a bit here, but they're not able to keep it. And then this part might even count as a doji up here, right over here. It's a little bit iffy, but that could be a doji too. And then another reversing the uptrend here, and it drives it all the way back down to where it started over here. So we get this double team of dojis that just drive the uptrend down from the buyers. If we look at the opposite end of the spectrum, we have Chipotle here, the Mexican restaurant, CMG. We see we have a downtrend over here. The price just crumbles over here, but we have this lone doji over here. And then look what happens. Skyrockets. So we see this downtrend here is immediately reversed by a single doji. Clearly, it's pretty powerful. This video, I can't believe, is running even longer than the fundamental analysis video, so we're almost done here. We have very little more to go, so bear with me. Important concept of buying and selling pressure. This is not a specific, it's not a specific candlestick pattern. It's just a general thing. And I consider this personally to be one of the most important concepts. In investing. In technical analysis, not investing. Technical analysis. This marker is not doing very well today. So what this is, I will mention most of the patterns you will see, like that I didn't mention today. If you do a little more research outside, a lot of the patterns that you will see are simply based on this. So if you understand this, you will understand most of the patterns without even knowing what they are. So it's pretty powerful there. Start with buying pressure. Happens when the sellers, the bears, try to push the price down. But the buyers or the bulls push it back up. So we can see what this tells us is that the buyers, the bulls, are in control. They're able to fight back the sellers, and are able to overcome their pressure. And so it is a sign that price goes up. And an example pattern that you will see is the dragonfly doji. The regular doji is kind of like a cross where the two wicks are the same length. The dragonfly doji is where it looks like a dragonfly. You have it's like a doji where the upper and the open and close are around the same, but you have a very, very small upper wick and a very long lower wick. So it looks like a dragonfly. And so why this is buying pressure is because we can see the stock opens up here, right? It opens up here, but the buyers, first the sellers. The sellers first drive the price down to a low, like a very, very far low. The bears start in control and drive it very low, but the buyers come back and shove it up all the way up, back to where it opened, and it looks like they're even able to push it up a little bit more, and so that is what buying pressure is. Is we can see that that the buyers are clearly in control. They're able to force the price back up to where it was before at the beginning of the day. And selling pressure is the opposite. Buyers try to force the price force the price up, but sellers push it down. And clearly this is a sign that the price will go down. An example of this, the opposite of the dragonfly doji, is the gravestone doji. Opposite scenario. Opens. A very tall upper wick and very low or even none lower wick, and it closes at roughly the same place. And so the opposite scenario happens here, where it opens here, and the buyers are able to force the price all the way up to here. But before the day ends, the sellers fight the buyers and push it all the way back down to where it was. And so clearly there's a lot of pressure there, and the sellers are in control in this area. They're able to fight the buyers back and defeat them during the day. And so that is the selling pressure. So I just gave you a few examples of patterns that follow this buying and selling pressure. But you can see, even if you didn't know the names of them, even if you didn't know that a dragonfly doji meant that the price will go up and the gravestone doji means that the price will go down, even without knowing these names, you can still, seeing these, you can still pretty easily guess what the signal will be. You can pretty easily guess that this is a bullish sign, this is a bearish sign, simply by understanding buying and selling pressure. And so this applies to many other trading patterns that you will see, like the hammer, the hammer, I forget what it's called, but there's a lot of symbols or a lot of patterns out there that are modeled after buying and selling pressure that you will see if you do a bit more research. So some examples. This is Moderna, maker of the COVID vaccine. mRNA is the ticker symbol. And the example of buying pressure that I want to point out here, right here we have a pretty nice dragonfly doji. We have, there is no upper wick. I cannot see an upper wick at all, but we have this massive lower wick here. We can see the day starts out at the very top here. The sellers are able to force the price all the way down to this bottom, but the buyers come back in control and push it all the way back up to almost where it was, not quite, but almost where it was at the start of the day. still show that the buyers are very, very in control here and are able to push the sellers back. As you can see, we got a very nice uptrend here, all the way up to here. It does crash a bit later, but in short-term trading, you don't really care about that. You want the very, very short term. So that is a pattern signal that it will go up. Next, we've hit the hour mark. Congrats, y'all. But this next one, we have American Airlines. Ticker AAL. You can see some selling pressure right over here and right over here. These probably don't count as gravestone dojis because the bodies are a bit too large, but they're still powerful. I'm sure there's another name for them that I don't know of, but the name doesn't matter because we can very easily see right here that we have some pretty strong selling pressure right here. Buyers push it up, but sellers fight them down. Same scenario here. This one, it's a very, very short-term dip. You see only a few days afterwards the price goes back up. But on this one here, we have a pretty nice downtrend here until it gets forced back up, which is pretty interesting to see. So buying and selling pressure can predict short-term uptrends and downtrends pretty easily. Just understand that, and you will have a firm grasp of how candlestick patterns work and what patterns will look like in the market. I believe we are almost at the end of our presentation. I just want to cover some final words here. One thing to note is general info about candlesticks. This will be similar to what I just talked about buying and selling pressure, but just some general sentiments, general information that will help you understand any candlestick pattern. So, I talked about what candlesticks are, but what do they really represent? What is the true, what do they truly represent? They represent the feelings of investors. They represent how investors feel about a stock. And so strong upward movement in other words, buying pressure, means investors feel good about the stock, which should hopefully make sense. That's buying pressure, which translates into trends. An uptrend means that investors feel good about the stock. And strong downward motion means investors feel bad about the stock. That's our selling pressure. And then a small body, we can call that a doji as an example, but it doesn't need to be a doji. It can just if it doesn't quite qualify as a doji, but it still is a pretty small body compared to previous candles. Means investors aren't sure. About where the stock will go. That's that indecision I was talking about earlier. And so you can see that this is kind of like a summary of all that I talked about today. I could have just summarized the entire lecture in these couple of bullet points. I didn't because I wanted to go into a bit more detail. But we can see that you don't even need to know the names of all the patterns. You don't need to know the name of the doji, the bearish engulfing, the bullish engulfing. As long as you understand all of this, then that is what any candlestick pattern is. If we see strong green candles, strong upward movement, buying pressure, strong downward motion, that is selling pressure, and then any small body, a doji can be an example of that. Means that investors aren't sure where it's going to go. That's indecision. So any pattern that you look on the internet about candlesticks will have some basis in this, have some basis in the feelings of investors. So hopefully that kind of crystallizes everything I talked about. It crystallizes it and makes you like kind of understand better where these candlestick patterns come from. Now, finally, the moment you've been waiting for, we're going to put it all together. Why should you care about technical analysis? Like I said before, you're investing for the long term. So why should you care about these short-term trading tactics? First of all, technical analysis. It's not the priority. Your priority is fundamental analysis. First you want to do fundamental analysis to decide on the stock you want to buy. Do your research, do all the stuff we talked about in the last video, and then, only then once you've decided, use technical analysis to find a good spot to buy. We call it an entry point. You want to find a good place to enter into the stock. An example: stock hits support, bullish engulfing, etc. So you want to use technical analysis to find a good place to enter the stock because you don't really want to buy when the stock's at a high, because one, you're missing out on potential profits if you compared to if you found a better place to buy the stock. And also, if the stock plummets after you buy it, after you do all that in-depth research and you buy it and it plummets, that can be pretty hard on your confidence, and it could even drive you to sell the stock early, which is definitely not what you want to do, especially after you did all that research into the long term. You don't want to sell out of it after a short-term failure. And so technical analysis can help you avoid that by finding a good spot to buy it in. So ultimately, if you use technical analysis and fundamental analysis together as a pair, you can maximize your gains. Both are very powerful weapons, and if you use them together, then you can really see great returns. So as a brief recap, you want to prioritize your fundamental analysis to find a good stock to buy, and then follow that up with technical analysis to find a good place to buy it at. So that was the longest video I've recorded so far, which is definitely, I didn't want to make it this long, so I'm sorry. We're closing on 70 minutes, but hopefully this was helpful. Hopefully it was a bit more interesting than fundamental analysis. I try to use a lot of examples to illustrate my points better. Technical analysis can be tricky, right? There's a lot of stuff to remember, but hopefully it makes intuitive sense and you're able to remember it clearly. So I hope this is helpful. Join me next time for the final video in the lecture series. Very exciting. Thank you all for watching. See you later.